In this part of our lecture, we are going to study how to value a stream or a series of various cash flows. So far, we have only analyzed the future and present value of a single cash flow, or of a single investment, or a single payment received at some point in the future. However, frequently, you will receive a number of payments, which will occur at different points in time. For example, you might get different receipts or payments in different years. In one year, you will get, let's say, £100 return. In the second year, you will get £200, and in the third year, you will get £500 return. Or the other way around. Sometimes you might be required to invest into your business different amounts in different points in time. In other words, you can be dealing with unequal cash flows. Apart from this, there might be situations when cash flows occurring in the future are of equal size. You are getting the same amounts of money, or you are investing the same amounts of money, and there will be two possible scenarios. Situations when these cash flows continue for a finite period of time, say for 10 years, or when you are dealing with never-ending payments, when they continue indefinitely. These situations are called annuities and perpetuities, and we will have a separate video lectures dealing with these specific financial products, how to calculate current and present value of annuities and perpetuities. For now, let's just focus on a stream of unequal cash flows, which occur at different points in time, different cash flows in different years. How do we value them? For example, in illustration, Paul has made an investment, for example, bought dividend stocks, which will pay £100 in the first year, £300 in the second year, £500 in the third year, and eventually £1,000 in the fourth year. And the interest rate, or the rate of return, is 10% during this period. And we are trying to figure out what is the present value of this series of cash flows, how much these cash flows will be worth in today's terms, how much is this portfolio or stream of cash flows is worth now. What is the present value, or what is the future value of this stream of cash flows at the end of the investing period? Answers to these questions will determine how much this portfolio is worth now, how much you should be paying for this portfolio, how much is this asset which generates this set of cash flows is worth in today's terms. A very critical information for any financial manager or investor. These are the formulas which we are going to use. Don't get scared. I will explain them and they will become very easy to you. The first formula will tell you that the present value of any stream of future cash flows is simply equal to a sum of present values of each individual cash flow which make up this stream. I will give you an example. You will understand. It's very simple. We take each individual cash flow, discount it using appropriate discounting factor, and add them up. This will give you a present value of this set of cash flows. And similarly, the future value of a stream of cash flows is simply equal to the sum of future values of each individual cash flows in this stream. Similarly, we simply take an individual payment, apply the appropriate compounding factor, and add up these payments. Now, to make it easier for you to understand, let's translate these formulas, this mathematical language, into a simple, easy to understand illustration. As I said, the present value of a stream of cash flow is simply equal to the sum of present values of each individual cash flows. Let's imagine that we are talking about a basket of fruit. The value of this basket of fruit, which contains 4 fruits, is equal to the values of each individual fruit. So it will be a value of an apple plus a value of an orange plus the value of the banana and the value of the pineapple. This will be our individual cash flows, which will occur at different points in time, in different years. For simplicity, let's assume that the basket itself is worth nothing. Let's apply this idea to value the actual stream of future cash flows. Let's imagine that we are considering the following investment opportunity. We plan to buy an investment property or some other form of asset which will generate an income of £5,000 per year after all expenses. This will be your net return. You plan to rent it out for 4 years. You plan to exploit this asset for 4 years. It will generate return for 4 years. Or if you don't invest in this specific project, in this particular opportunity, you can deposit your money in a savings account which generates 5% return. This is your return from an alternative investment. How much money would you be willing to give up today in order to receive this stream of future cash flows which this deal offers you. How much is it worth in today's terms? How much should you pay for this particular property? Let's have a look. So we have this stream of cash flows, 4 years, in which we will receive £5,000. So what is the value of the first cash flow in year 1? Let's calculate this particular value. Let's imagine this is the value of our first food in Apple. Present value is discounted, so £5,000, discounted using our discounting factor, 5%. Number of periods is 1. We will receive it in the first year, so 1 year from now on. And as a result, this particular cash flow is worth £4,761. Now, we are prepared to pay this sum in order to receive £5,000 in a year. So if we are only able to receive this stream of future cash flows, we shouldn't be paying more than this for it now. Because if we invest this money in a bank account, we will be able to earn 5%, which will get us to the same capital. Next, second cash flow in the second year. We'll calculate the value of an orange now. Second cash flow received in the second year. The value of this specific cash flow, again, will be £5,000 discounted using our appropriate discount factor, raised to a power 2, because we're going to receive this cash flow in 2 years from now. So n should be equal to 2 now, and the value of this cash flow is going to be equal to £4,535. And in a similar way, we calculate all remaining cash flows. In the third year, our value, this particular cash flow, the value of banana, will be equal to 4,319. We're discounting again slightly more here, slightly bigger discounting factor, raised to power 3. Same interest, but raised to power 3, because it will take place in 3 years from now on. And similarly, the final fourth cash flow is worth £4,113. So we've calculated individual cash flows for each individual year. And now let's add them up. So we are calculating, we are valuing the stream of these cash flows from this investment. So £5,000 in every single year, but discounted using different discount factor. Again, same interest, 5%, but raised to different powers. And as a result, the value of each cash flow will be different. You can see here that the further you move in the future, the lower the value of this cash flow will become in present terms. More recent cash flow is worth more compared to what you will get in the future, because it's risk, first of all, and because you could be earning 5% in alternative investment, but you will be prepared to give up less today in order to receive this cash flow. If you add them all up into our basket, our apple, orange, banana, and pineapple, you will get the present value, £17,729. So this is how much it's worth now. What you can do now to check this, you can simply try to recalculate it in the other way around. What if you invest this sum at 5% for 4 years and withdraw £5,000 every year? How will it work? So let's just calculate the stream of cash flows from an alternative investment. If you don't buy a property, instead, if you invest this sum in a bank account, let's fill in this table. Our initial balance is what we've calculated, 17,729. If we invest it at 5%, at the end of the year, we'll accrue this amount in interest. We will earn £886. At the end of the year, we want to withdraw £5,000. This is our cash flow. We want to receive this cash flow. We withdraw this, and we are left with £13,600 at the end of the first year. In the beginning of the second year, we invest this specific sum, whatever is left. We accrue some interest on top of this capital, 680. At the end of the year, we withdraw £5,000 as well, because we try to replicate our stream of cash flows, which will leave us with a smaller sum, just less than 9,300. We invest this amount in year 3, accrue some interest, withdraw 5,000 at the end of year 3, we'll be left with 4,700, invest it again in the final year, accrue even smaller interest, which nevertheless will generate exactly, will be equal to exactly £5,000. At the end of year 4, we withdraw this money and we'll be left with nothing. So strictly speaking, this
table illustrates the same idea that if we invest this amount now at 5% and withdraw £5,000, we get £5,000 cash flow every year, we will just spend all of this money. So a stream of all these cash flows, £5,000 in each of the consequent 4 years, will be worth 20,700 now, when interest rate is equal to 5%. That's an illustration. Basically, we've done all of that in order to determine how much we should pay for this property. If you are offered to buy this property for more than the amount which we've calculated, let's say someone asks you to pay 18,000 or 19,000, you know that it's not worthwhile because you will be generating more money in an alternative investment. If, however, someone offers you to purchase this particular property, this deal, with this amount of cash flows for £15,000, you will be better off because you won't be able to get as much in your second alternative investment. You will be better off investing in this particular property. So strictly speaking, this method tells you how much you should pay for each property based on its future rental potential. You know how not to overpay if you are able to do this sort of analysis. How do you apply this to evaluate your investment opportunities, your investment projects? Strictly speaking, by discounting your future cash flows, you know how much you need to pay for an investment asset. And you can do this for properties, for business, for stocks, for anything, because any asset generates cash flow and any asset is valued in the same way. Math can be more complex. For example, number of years can be different, type of cash flows and outflows can be different. But the idea remains the same. You lay out all cash flows in a particular year, and you create a table describing what money you will need to pay, what will be your outflow, what money you will receive, what will be your income in each particular year, and then you add them up and discount using the appropriate discount. And that's it. So in order to appraise any investment project, you just need to know the future cash flows it will generate and your discount rate. So your best alternative. So what is your other alternative return which you can get in a comparable investment with a comparable risk?